Buy the dip is a cheat sheet trade entry signal used in trending and recovering markets. It's based on the interaction of the last 4 items that you see in our pre-trade checklist, which comprise the multi-time frame market forecast indicator. In the big picture, stocks are making an inconsequential 2 to 5 day pullback in the context of an overall bullish intermediate uptrend. While the following additional rules aren't necessarily part of the strategy itself, we nevertheless strongly recommend requiring at a minimum that a trade candidate either has a bullish long-term trend posture or a bullish intermediate trend posture, preferably both, before you buy the dip. So what does that mean? It means factor 1 or factor 2, or both, on the pre-trade checklist needs to read bullish or better. In addition, look for a tailwind score of 50 or more and buying pressure. That's factor 4 in our checklist that reads at least neutral plus, but again, bullish is better. A valid buy the dip signal requires the following. We'll want the market forecast intermediate oscillator to be bullish or better, and the market forecast near-term oscillator, that would scale back to a reading of neutral. The momentum oscillator has no specific required reading. However, it must not close in the quote-unquote danger zone. Anything else is fine. So let's look at these oscillators on a chart so they make a little bit more sense. The example we're using is for the ETF TAN that looks like it's reaching most of our trade requirement minimums. We're in a recovering market as I record this, having spent the last 6 months in a global equity downtrend. There's also divided opinion now about the direction to come and about how much worse things could get, even though markets have settled in, at least for the time being. But it's okay. It's important to understand that with buy the dip, you're not marrying an equity for a multi-year period. There's always going to be a wall of worry to climb, and trend following strategies like this one gives you the perfect balance between the risk of trading when there's a lot hanging over the market and not trading, which means that you're not making money. So if anything, TAN itself is in a multi-month long-term sideways consolidation, at least based on our time frame of what long-term means. The market forecast is making a case for TAN breaking out of a very short-term symmetrical triangle pattern that you see on the chart here and breaking out to the upside. The market sentiment oscillator currently stands at 59 and rolling up, having transitioned from neutral plus sentiment under 50 to bullish over 50. So this is now solidly bullish in terms of a long-term market sentiment, which suggests that TAN could trend higher for multiple months, and we may be at the beginning of a trend that lasts quite a while. The market forecast intermediate oscillator has likewise broken above 50, kind of confirming the bullish outlook, at least for the next 1 to 3 months, because it doesn't cover as long a time frame. Meanwhile, the 2 junior time frame oscillators have pulled down into buy the dip orientation. The blue line, which is the near-term indicator, that's dipped below 50, but it stayed above 20. That's a requirement. And the red momentum line closed above 5. That's the second requirement. We're outside the danger zone on the shortest term time frame. Since we'd be looking to buy the dip on Monday in response to this end-of-day trading signal from Friday, it's important to know that the junior time frame indicators continue to signal, hey, this is a harmless pullback, by staying above those 2 key levels, 20 on the near-term blue and 5 on the momentum red. I'll be comfortable placing a trade just after the market open on Friday as long as I don't see those indicators heading south. Though normally, these indicators only matter end of day. Finally, when we take a trade like buy the dip when the security is in effect going sideways and pressing up against resistance, this is definitely a more speculative trade, and we have to respect it as such. So a bit about risk management here. What I've done is now put this chart for TAN against a 21-day exponential moving average. That's the green line you see just below price here. So it's the average price of the stock for the past 21 days, with the most recent days accounting more toward that moving average. And just below it, you'll see a volatility type band that's called a Keltner channel. Now, I'm not going to get into that today, but the idea here is we give ourselves a chance to allow the stock to meander just below the 21-day moving average for a little while, if it needs to, before ramping up and going what we hope will be higher in price. So the difference between the 21-day exponential moving average in green and this stop loss price, known as a Keltner channel, that'll be the risk of this trade, because we're essentially at the 21-day moving average right now. So if we want to do a risk calculation, it's pretty easy. $72-ish will be our entry price, $68 our line in the sand. Out if price reverses and any one of these factors that's lining up against us for next week goes against us, we'll get out of the trade with a minimal loss. And we can figure out how much money to put at risk by knowing what our entry is and what our exit, which we've just planned, will be. And otherwise, we stay in this trade. We'll keep riding that 21-day moving average and the associated Keltner channel that's underneath it. What we hope will be up in trend for months and months and months. We don't set a price target. We just keep following it up until we hit our stop loss. And it'll always be probably about $4 away from the moving average, just like it is now. Although with the Keltner channel, the nice thing about it is it'll expand and contract slightly based on volatility. So we give the stock a little bit more wiggle room when the market is fearful and stocks are gyrating all over the place. And when everything's kind of calmed down, we don't give the stock as much wiggle room. It really needs to keep going higher. All right, so position size. The difference between our entry and our exit is our risk. The total amount of capital that we're willing to put at risk in any one trade should be about 1% of our trading account. So let's imagine we have a $25,000 total trading account to work with. And we don't want to lose more than 1% or $250 on this TAN trade. And we're at risk by $4 per share. So the way to calculate the total number of shares that we can purchase and stay within our acceptable risk threshold is we take that $250 in total loss and divide it by the $4 per share in trade loss. And we come up with a number that's going to be just above 60, and that's like 62 shares, and that represents the total number of shares that we can hold and follow our rules about trade risk. Now, the second risk we have to deal with is our portfolio risk. The fact is that a stop loss is not a perfect exit mechanism. In fact, a lot of black swan events can happen after hours where we have no ability to act on this new information. Bad information happens all the time, and stocks routinely gap down 5, 10, even 20%. And a narrow ETF like TAN is no exception. So we have to anticipate that level of event being a possibility. So our second rule is never invest more than 10% of your trading account into any one equity. And so if we have a $25,000 investment account, we don't want to allocate more than $2,500 to any one trade. So that would be the maximum investment for TAN, $2,500. And we take that $2,500 maximum investment and divide it by the current share price, which is roughly speaking $72, and we get just north of 30 shares. That would be the total number of shares that we could hold and be holding to our rules about portfolio risk. So risk management calculation. You always want to run the numbers two ways and then buy the lesser of the two share values that you get back. 1% of your trading account as an acceptable loss for the trade. 1% of $25,000 is $250. You take that and divide it by the difference between the price you enter the stock and the price you get stopped out. In this case, that difference is going to be around $72 to enter, $68 to exit, a loss of $4. We divide $250 by 4 and get in the neighborhood of 60 shares for this trade. But we also look at it another way. 10% of our total portfolio can't be dedicated to the trade. So $25,000 our total account, $2,500 our total portfolio cap. TAN trading at around $72 gives us a little north of 30 shares to work with. So between the 60 number and the 30 number, we're going to take the 30 number. And that's how we position size to minimize our risk. All right. I think that will do it on the buy the dip signal. Please subscribe at stockcheatsheets.substack.com, and I'll be able to deliver more trading signals to your inbox. Thanks for listening. Bye-bye.